Well, good afternoon, everybody, and welcome to our second session of our Savvy series on getting in financial shape for a mortgage. We're excited to have you here. Just a little housekeeping. If you just keep yourself on mute, we're doing this as a meeting format. So if you just keep yourself on mute, if you have any questions, you can type them in the chat. We will answer them at the end. We'll have a little time for Q&A. And I just wanted to bring attention that if you have a personal question that you wanted to ask, you are welcome to come to our helpline, and we'll put that in the chat so that you'll have the link for our helpline. But without further ado, let's get this started. We have Lori and Debbie standing by, so I'm going to turn it over to you.
Okay.
Thank you.
Thank you so much, Tracy, and thank you, Judy, and thanks everyone for participating. So I am Laurie Itkin, and I'm here today again with Debbie Katie. We were here last week, and we went over the basics of how to get in financial shape for a mortgage, and the Savvy Ladies team has already posted that video to YouTube. And so we're going to go over briefly what we talked about last week, but we are also going to talk about more complex cases, more advanced cases. And I'm just want to make sure that because I can't see you, if everyone can see my screen, let me know if there's any problems. Okay. So I am with, as you can see, I'm Laurie Itkin. I'm a financial advisor and certified divorce financial analyst. My company's The Options Lady. And I'm with Debbie Katie, who is with Caliber Home Loans. And Debbie and I work together on my client issues when they are trying to obtain a mortgage for the first time or refinance an existing mortgage. Okay, so bear with me, I have to minimize something. Okay. So what did we cover last week in part one? These are the points. And if you have any questions about these, again, I encourage you to watch the video if you weren't here with us last week. We covered determining if you can afford to purchase and maintaining a home. It's not just about qualifying for the mortgage, but can you actually afford to be a homeowner and all that's involved with that? What is needed to qualify for a mortgage? We talked about how you can improve your credit score, sometimes fairly quickly. Debbie talked about that. We talked about the common types of mortgages. We talked about the common mistakes when preparing to qualify for a mortgage. And then we talked about the options for obtaining a mortgage. So those, again, are all covered in the video from last week. Okay, so now want to invite Debbie to talk here. We were looking at what are some creative ways to qualify for a mortgage when the obvious isn't possible. So, and Debbie, I know that when we work together with women who are trying to qualify for a mortgage, you have often recommended a co-signer. Can you talk a little bit about how that works, obtaining a co-signer and what that co-signer needs to do and look like?
Of course, I'm happy to. Thank you, Lori, for the introduction. So oftentimes we need additional income to qualify the home buyer or the person looking to refinance. Let's say they're going through a divorce, and half of that, let's say some of the income is now gone from the ex-spouse. So we look to either a family member or a close personal friend who has good credit, verifiable income. And the main thing I want to emphasize is they don't need to live in the property with you. They are what's known as a non-occupying co-borrower. And we do this all the time. So even if you're looking to refinance and you don't think you can qualify on your own, get a sibling, a close family friend, a parent, even a son or daughter to help co-sign for you. Now, what are the implications of that? They will be required to go on the loan and on the deed. Now, if after
Oh,
you
on the
close,
deed. So that's interesting.
typically,
So
yes.
they actually are
Typically,
now,
yes.
are they going to be a co-owner of the home? Does it have to be a 50% or just their name?
No, just their name. But what oftentimes happens after closing is we can take them off the title, okay, so that they have inherited essentially half of the liability, but they're not sharing in the asset. Follow?
Got it.
Yeah. So this is a very commonly used way to get people to qualify. Again, it can be done on a purchase loan or a refinance.
Now, if I'm being asked to be a co-signer, what does that mean for me? I mean, if I already have a mortgage or already have debt, would that limit my ability to be a co-signer for somebody?
It could. That's a great question. So what we do is we look at the potential co-signers' current expenses, housing expenses, liabilities, and as long as sometimes I need literally 1,000 or 2,000 a month in qualifying income to make the loan work. So it depends on their financial situation. And we do pull credit because we want to make sure that they're not being a detriment to our primary borrower and that they have equal, if not better, credit. But the credit will still be based on the occupant, the primary occupant.
That's a wonderful way to really bridge the gap. It's something to definitely explore. And I've even had a case where, funny enough, the ex-husband did agree to become a co-signer.
It's not unheard of. It's not unheard of. People will do things for each other to enable things to happen. So
Right.
a co-signer is, again, we call it a co-borrower. You can have more than one too. So yeah, I did a transaction last year with some siblings. 4 of them were purchasing a home together, but they were all purchasing together to live in the property. And it was complicated, but we got it done.
Wonderful. Now, the next issue is something I have lots of experience with because I have I'm a wealth manager. So I have clients that have individual retirement accounts. And often they're in their 50s, 60s, or 70s wanting to qualify for a mortgage. And what we do is we start taking monthly distributions from the IRA. And if they're over 59 and a half, those distributions, they do not pay an early withdrawal penalty. And in fact, they may have up to 60 days to sort of put that money, not sort of, they may have up to 60 days to put that money back. Although in some cases, they may be treated as taxable distributions. It gets complicated. I don't like doing this because we're always under the gun. I'm pleading with them, get the money back within 60 days. Otherwise, you're going to be taxed on the distributions. And if you're under 59 and a half, you may have to pay the penalty. Do you have any, I know you've done these too, Debbie. Do you have any tips or guidelines for this type of strategy?
You know, I do, Lori. And when it comes to retirement accounts, sometimes people will borrow against, they'll take a lump sum against the retirement account. And I believe that's what you're speaking to with respect to the 60-day time frame. I've had people do that, but it makes me nervous. Now, if you're of the appropriate age where you can start a monthly distribution, a couple of things to keep in mind. I only need verification that the distribution is being set up, and I need 1 month of receipt. I don't need 6 or 12 or 24 months of receipt of that income. So that's what, Lori, where you and I work together to make sure that we are within the tax laws and that we're doing everything as we should. But this is very commonly used to, I would say, maybe somebody who's over 60. Don't you think it's more of a safe bet because they're over 59 and a half? And
that's
it's their money.
Exactly. So just for those of you on watching this, with any IRA, required minimum distributions must start at age 72. Again, unless it's a Roth IRA, but I'm not talking about a Roth IRA right now. And if you're over 59 and a half, you can start taking monthly distributions and you just pay federal and state income tax on it like it was a salary. It's if you're less than 59 and a half, you get into some penalties, and people are under the impression that you can borrow from an IRA. You know, you cannot borrow from an IRA. You sometimes can borrow from a 401k or a 403b, but this is something that is a very viable option. If you're over 59 and a half and you have funds in an IRA, we can talk about it to use to help qualify for a mortgage, but it's tricky. You have to be disciplined, and you can't, you have to be on the ball. I mean, big time on the ball, because it'll cost you money if you want to stop those distributions. It's complicated, but it's done all the time.
Yes.
Okay. Now, we talked briefly on this last week. Let's talk, and I know they're not as popular as they were, but if you really can't qualify, you don't have enough qualifying income, what is the option in terms of a no income verification mortgage, and then possibly refinancing into a more conventional mortgage later on? Can you tell us about that?
Absolutely. So this is often a two-step process in the home purchase process. Let's say typically the buyer is required to be self-employed in the same line of work for the last 5 years. Now, there are different ways of structuring a loan without tax returns, without W-2 statements, without K-1s, and without pay stubs. And that would be what you have here, a no income verification mortgage, or also known as a non-QM, a non-qualified mortgage. So it falls out of the normal guidelines, and these programs that are primarily designed for people who are self-employed, they've come back, which is great news. They went away for a few years after the mortgage meltdown, but they're back, and there is stringent qualifying criteria in terms of credit scores needed. You can't have a 580 credit score and apply for one of these programs. Now, what this program often uses to qualify are bank statements, only bank statements, okay? And for instance, my company, Caliber, has a 12 or 24 month bank statement program whereby we analyze the deposits and come up with an income figure, okay? Now, I will caution that these programs that are outside the normal loan program variety, typically they might be an ARM, or it might be a fixed rate loan with a higher interest rate. That's because there's additional risk involved to the company making the loan.
Makes absolute sense. The riskier the investment, the higher the rate of interest, whether you're investing in something or you're lending money to somebody. That's how it goes.
Exactly. Exactly.
Now, what about when people say to me, I have like $1 million in stocks and bonds and retirement, and I still can't qualify for a mortgage? I mean, people tell me their frustration that they may have a high net worth, but they still can't qualify because they don't have income right now.
Right. Well, we use tricks of the trade. The agencies, if you will, Fannie Mae and Freddie Mac, allow us to use a calculation called asset dissipation. And so the buyer is thereby qualifying based on their assets, not their monthly cash flow. In essence, what we do is, if we took $500,000, okay, in assets and divide it by one calculation we utilize is divided by 240 months, that there's the income.
And
I just closed a
months,
loan.
right? So you're basically saying,
they have enough to qualify for at least a 20-year mortgage, but they can actually obtain a 30-year mortgage. And so we allow their assets to work for them.
Got it. So it's almost like we would pretend that you have enough assets to pull out every month for 20 years without going to zero. And there's some formulas and calculations on that, but how interesting that you could actually qualify for potentially for a 30-year mortgage with a 20
Yes.
years worth of stream. Fascinating.
Yes, yes, very commonly used. And it's
Wonderful.
an experienced loan officer will know what they have at their disposal in terms of programs like this. And Lori, you and I have worked long enough together. You just need to get into the nitty-gritty of the client's situation, find out what they have. Is it stronger on assets? Is it stronger on verifiable income? We talked a lot about that last week.
Right. Okay, so the last point on this is that if you are receiving child support, or you're receiving, we call it in California spousal support, but in New York it's called maintenance. Alimony is the general term. So I work a lot with divorcing couples who are in mediation, and therefore we can do a lot of interesting things to structure the support payments with the absolute goal of helping you qualify for a mortgage. So for instance, if typically, and you'll let me know if there's any changes to this, but typically when I'm working with the wife or the couple together, we want to make sure that there's a history of 6 months worth of support going from one spouse's bank account to the person who's trying to qualify her bank account. None of this, joint stuff here and then deposit. Oh, you owe me $50 for this that came in. I'm going to deposit, subtract this month's from this month's support payment. This that we had this and no. So we get them on a routine, and then if the settlement agreement, sometimes it's called a separation agreement, basically in your divorce decree, the agreement that you've made, you have to show that support continues for at least 3 years. Now, here's where we can get creative. Child support typically is something that really can't be deviated from. I mean, there's most states have pretty strict rules and parameters and procedures for determining that number. But spousal support, I've had cases where we have the husband or whoever, whatever the gender is, but in most of the cases, the husband, he will front end the support payment. So we will find out from the mortgage lender how much in spousal support is required for her to obtain the mortgage. And let's say he's agreed to pay $2,000 a month, but she really needs to show $3,000 a month. We will have the settlement agreement say that the first 3 years, or maybe 3.5 years, just so we get some of that qualifying income, is at $3,000 a month. And then he bumps it down to $1,000 a month in year 4 or 5. We also have issues where people forget children age out. So if you have 2 children, one who's 16 and one who's 11, we probably can't use the child support that's paid for the 16-year-old because that person will age out of the system. So if you are, here's another reason why couples, if possible, should go to mediation for their support agreements, because unless you're in mediation, it's going to be very hard to negotiate something like this. So the other thing to think about is if you are the payer of child and spousal support, the same thing. If you are hoping to qualify for a mortgage, then you may need some adjustments on your part to reduce your obligation for the first 3 or 3.5 years. So it goes both ways. Debbie, I know you have thoughts about this. You have experiences with this, and we will talk about a case study. What are your thoughts?
We often use a combination of spousal and child support, or one or the other, to help qualify a borrower. The keys are exactly what you stipulated: 6 months history and 3 years going forward. And as long as records are kept properly, it's a non-issue. And I think Lori, to your point, being creative in possibly adjusting the numbers, let's say after 3.5 years, is a very viable solution to help our person get into the house. And what happens down the road it's really none of our business as long as mortgage payments are being made on time.
Right.
So yes, we do have to watch the child support with the ages of the children, even if the paperwork stipulates that the support will continue if they go to college. We have no guarantee that they're going to go to college. So I've seen this more than once. Okay. So we have to be careful. We do ask for the divorce paperwork up front so we can
Terrific.
analyze that.
And one other note on this is that I have situations where parties are negotiating a lump sum spousal support payment instead of monthly payments. And I think, whereas I like that idea for many reasons, that might actually not work for a mortgage. If you get a lump sum spousal support, perhaps that may hurt you in qualifying for a mortgage if you can't say I'm going to get $1,000 or $2,000 or $3,000 a month.
Well, yes and no. Now, remember, we could possibly default back to the asset dissipation idea.
Yes.
So if our person is receiving 200,000 or 500,000 in a lump sum settlement, we could still possibly get that to work.
Wonderful. And you also have money for a down payment when you get the lump sum. So
exactly. But you can't count it twice. You can count
you
it.
can't count it twice. I figured that one out. Okay. Good try, everyone. Good try. You can't, no, Debbie says you can't count it twice. Okay. Okay, so here are some tips for refinancing before and during a marriage. And we do have 3 case studies to share after this, but let's talk about these. So I have to say 1 out of every 5 times, I have a couple who've been in this home forever. I mean, not really forever, but you know what I mean. Let's just say there's 20 years, there's only 10 years left on the mortgage. And the person staying in the home who wants to stay in the home says, Laurie, why would I need to refinance this mortgage? I'm just going to pay the mortgage. I'll just call Wells Fargo or Bank of America and just say, I'm going to just assume the mortgage. Well, why is that not right?
You can't do that.
Okay, why can you not do that, Debbie? Ms. Katie, why can you not do that?
You cannot just legally, okay, let me rephrase that. Because typically what we're finding, Lori, is one of the 2 people no longer wants to be obligated on the mortgage. Okay. The rule is you can't just remove somebody from a mortgage. You can remove somebody from the title to the property, but not the mortgage. So therefore, a refinance is required.
And that makes sense that if you are now going to be borrowing or lending to just one person instead of lending to 2 people, it might, if I were the bank or the mortgage lender or whatever, I might want to know what is my risk now of repayment if I no longer have 2 people on that mortgage obligated, but only 1 person.
Right. And along those lines, so there could be 2 different types of refinances involved. As you know, many of the ones you and I work on collectively are where one spouse is cashing out the other with half of the equity. That's considered a cash out refinance. The other type is simply a rate and term refinance where they're removing the other borrower and refinancing on their own, basically rolling over the same loan balance and just financing the closing costs.
Now, I've worked on situations where the spouse that is not, and I didn't actually put this here, but as a tip, but oftentimes we have a situation where in mediation in particular, we will give the spouse who's staying in the house time to refinance the mortgage. So perhaps she will be given a year or 2 years to stay in the home. Husband will stay on the mortgage temporarily, but that if she can't refinance in her own name by X date, she will need to list the house for sale, or they will need to list the house for sale. And that's, I think, a really fair way to do it because it gives the person staying in the home some time to improve their application, and that the spouse leaving the house has some sense of certainty over when he or she can move on with their lives.
Giving them time is really important because there's nothing more stressful than to have a 30 or 60-day time frame hanging over your head. I can't imagine having to go through that. But if there is, for instance, a 60 to 90-day time frame that we have to work within, we're going to look at every option to get them qualified, including a cosigner.
Wonderful, wonderful. Okay, now, is it best to refinance a mortgage before the divorce petition is filed, or can you do it after?
It depends. How cooperative is your soon-to-be spouse? Are they willing to sign? For instance, the first question we have to ask is, are you located within a community property state, such as California? We are a community property state. Therefore, the soon-to-be ex has to sign off on the mortgage. They're agreeing that a new loan is being made, but they're agreeing not to be on title and not to be financially responsible. So this is definitely a bone of contention we have to address up front. I've had escrows delayed because one of the spouses would not sign that paper. Other
and
ones.
Which paper is this? What's the paper?
This is it's a quitclaim deed.
Okay.
A quitclaim deed. They're signing off on their interest to the property. And it's required in the community.
If there's $500,000 worth of equity in the property and the spouse leaving the house is entitled to $250,000, I'm oversimplifying things, but you can imagine they may not want to relinquish their right to $250,000 when you haven't finalized negotiating how you're going to split up all the assets.
Exactly.
So
go ahead.
No, I was just saying you need cooperation and trust.
You really do. And I think the best time to initiate a refinance would be once those bullet points are addressed and agreed to. So you have a couple who's in the process of a divorce. The divorce may not be final for a while for whatever reasons, but they are agreeing to have the person moving out is going to receive half of the equity. So therefore, it becomes a cash out refinance. That person is going to want their money, so they're going to sign that document.
Got it. Okay. And so I think we sort of touched on this, but I think you're basically saying that it is common that one person may be on the mortgage while both people are entitled to the house, and then you have to go through these. It's a process to do that.
Correct.
Okay. Other things that I've encountered with clients, we get into people, it's so interesting. It depends the type of person you're working with. Some people are so detail oriented. They tell you everything up front. Other people tell you what they think you need to know, but we really need to know everything if we're going to help you. And all of a sudden I'll be halfway into something trying to solve a problem. And all of a sudden, oh, there's a HELOC on the house. Not only do you have a mortgage, there's a HELOC. And then, oh my gosh, there's one of these solar loans or these hero loans. And so what do we need to know about that when we're refinancing for a mortgage?
The first questions I ask a potential client are, how many mortgages do you have? Because a HELOC or a home equity loan is it's a second mortgage. Okay. So I ask them, what do you owe on this property? I need the dollar amounts. I often ask for them to send me mortgage statements, and because that all goes into the analysis. The hero loan affects a refinance, okay, and that is used to finance energy efficient items and solar and things like that. Sometimes people forget about those types of loans. But what we do as part of the early stages in the process is we order a preliminary title report, okay? And that report is going to show us any current liens on the property.
Excellent. So even if they forget they have it, you'll find out.
We will find out, yes.
Great.
We will uncover everything.
Okay, now you mentioned this a little earlier about using a cash out refi to buy your spouse out. And I'll give an example. Let's say the house is worth $1 million. There's $500,000 left on the mortgage. again, forget fees and brokers fees and closing costs and all, and capital gains tax and all that. Let's just say then there's 500,000 of equity. Let's say that you're splitting equity 50-50. So now the person staying in the house there's already a $500,000 loan that the two of them are on. And now if there's no other assets to buy out the other spouse, one must then think about, do I now refi for not 500,000, but 750,000, so I can take 250,000 and pay my spouse? And again, they're not whole numbers because there's fees, transaction costs, and all that. What are some advice or tips on that? Things to think about, strategies.
Knowing what the couple is agreeing to do moving forward is really important for me to know, so that I can help them structure the transaction. If they've agreed to split the equity, then yes, we know automatically that loan amount is going to increase to cover the cost of the buyout. Okay, so I think just having an honest, in-depth conversation up front and asking for the paperwork, it doesn't bind anybody to an obligation for the loan. But my job as a loan consultant is to basically look at the big picture, put everything together, and offer them what I feel will be how they will be best served.
And likewise, I have a role as well as a certified divorce financial analyst, and I'm a divorce financial planner. So if we find out after I'm working with the client that there are really no convenient other assets to use to buy out the spouse's share of the equity, and that a cash out refi is the only option, can now you afford on your own income a $750,000 mortgage? You might be able to qualify for, with the co-signer and various things like that, but can you really manage that monthly nut? And so we have times where I have to say the bad news and say, I just don't think refinancing this mortgage is in your best interest right now. Sometimes it is.
Exactly. And to your point, sometimes you do have to face the harsh reality that perhaps the couple is better off selling the home and having our client buy something smaller and less expensive and affordable for them. So that's a conversation we definitely need to have.
Absolutely. Absolutely. All right, let's talk about some of the case studies that you've prepared for us. We have the first one where this is very common. I mean, I work with women all the time. They're newly divorced, and now maybe they sold that previous house and she wants to buy a new house. So tell us a little bit about this story.
Okay, so this is where all the questions that we ask and all the paperwork we ask for are going to let us know if this newly divorced person can qualify on her own. And I'm looking at my own notes, by the way, here. So oftentimes it's a combination of different sources of income. Let's say the person is receiving support, okay? So we can use a combination of different income sources to qualify. If they've been working, let's say part-time, which is this case study, I just had one like this, we can count part-time employment as long as we have close to a 2-year history of it. So oftentimes it's a multi-layer effect. So we take the part-time income, we'll average it over 2 years. We will use the alimony in combination with that, as long as it meets the criteria to qualify her.
Yeah, you're piecing together various income sources.
Absolutely.
And maybe we have an IRA withdrawal as well to help.
There is no limit as to the number of income sources. Really, there isn't.
Wonderful. So we're going to go through 2 more case studies, and then we'll be here to take questions. So please chat in your questions as you have them, and we'll get to them shortly. Okay, case study 2. This is my main bread and butter. Wife, sometimes husband, wants to stay in the marital home. They're getting a divorce. I mean, a woman will say to me, I only want to stay, my biggest priority is staying in the house. I don't want my kids to have to change school districts. I don't want to, I've got to stay in the house. I'll do anything to stay in the house. Okay, you case study, walk us through it.
Okay, so this is your typical cash out refinance scenario where, especially when kids are involved and you don't want to uproot them. And I get all that. I've been there personally. The key is the bottom line is to determine as quickly as possible if the remaining spouse can afford to do this. And if they can afford, or do we have to look outside, for instance, to a co-signer or whatever means. You don't have to have full-time employment to qualify. You can have assets, you can have a co-signer. So this is very, very common. And by the way, I'm currently working with someone like this, and we can use one appraisal for both purposes. A lot of people don't know that.
What do you mean by that?
Okay, we can use an appraisal for the mortgage, okay? But then the couple can use the appraisal to determine fair market value for the buyout.
Ah, yes, that makes sense.
Yes, so why go through the expense and the trouble of two appraisals when we can use one? And keep in mind that appraisers are so highly regulated these days. They're not part of my company. They're an independent appraisal company. And so it's as good as anything. It's not the Wild West anymore with appraisers. It's a very random selection, and it's nice to be able to just basically streamline the process using one appraisal.
It's certainly a very important data point because, as you can imagine, I mean, when I don't say you don't have to imagine anything, Debbie, you go through it all the time. But as folks watching this can imagine, the person staying in the home is going to argue that the home isn't worth very much. And the person who's leaving the home is going to argue the home's worth a lot. And sometimes I have to get this couple together and I say, okay, if you were to sell the house, who would get what? What are market comps that a realtor may do? Some people want to use Zillow or Redfin. Those aren't really accurate, so it's a great thing to know that the appraisal can be used. Sometimes we have a second appraisal, or whatever the couple needs to do to try to get agreement on what the fair market value of the home is. And this is constantly a contentious issue, even among amicable couples. It really is.
Sure it is. Sure it is. And in a situation where the couple agrees to do two appraisals, you can take an average of the two to determine that buyout figure.
Right. Excellent. Okay. Now, last case study, recovering from bad credit. Is it possible, is there light at the end of the tunnel?
There is. And I've had this is near and dear to my heart. I helped a veteran a couple of years ago. He was going through a divorce. She went off the deep end, and this was a severe case of credit issues. They almost lost their previous property because she wasn't managing the finances appropriately. So I literally worked with this borrower for a year to rebuild his credit after they sold the other property and get him in a position to purchase on his own. And it involves what we discussed last week with credit rescoring, using certain software programs to make recommendations if they have to contact creditors or pay down debt. This client is so grateful. And as a matter of fact, after I helped him buy a condo for he and his two boys, he refinanced it last year when rates were really low. So it makes me feel really good to help people like that.
Well, it's interesting because sometimes this is a very long-term process, although the way things go, people want action right away, but they don't realize that it can take a long time you have to spend a lot of time yourself as the borrower organizing your materials, doing this, working with you, because you can't help them unless they are going to make this a priority. And we all know the document dump, the data dump. I mean, you need everything. It's like filling out your taxes. I mean, it's even worse than that sometimes. And certainly, the only good news, as I can say, is when you're going through the divorce process, you're showing all these documents anyway. So, hopefully, you just can't avoid it. You've got to make a commitment. If you want a mortgage, you're going to have to provide a lot of information in a timely fashion, because you, Debbie, cannot help them if they haven't given you everything you've requested by the time you've requested it. I mean, we've worked together. I've referred many clients to you, and oftentimes they have this thought in their head, oh yeah, I want to refinance the mortgage, or I want to do this, one or that. And then 3 months goes later and they've missed the opportunity. Interest rates are rising, folks. We've had unprecedented low interest rates. I mean, that my husband and I were able to, refinance our mortgage maybe 2 years ago for 2.75% is just, we're not going to see those rates again, I don't think. So
nope, I don't think so.
If you are in the market, just know when you delay, interest rates can be going up, up, up. Yeah, sometimes they go down, you can refinance, but this stuff takes a plan. You can't just sit on the couch and be passive. It's a commitment.
And I'd like to add to that, Lori. One of the first things I attempt to do when I'm introduced to a new potential client is I need to gain your trust. Okay. You need to feel comfortable divulging everything I need to know about your situation that applies to getting a mortgage. Okay. What my clients tell me, I will then process, and then I will put it in writing. I decide what gets passed on to the processors, the underwriters, my team of people who help get this through. But I'm here to be creative, and I'm here for them. My end goal is to help them do what they need to do and hopefully make it a seamless process. So
Wonderful.
Cooperation is really important, and honesty, and don't withhold anything.
Wonderful. All right, we've got some questions, and
Yay.
So basically the credit rescoring, Mary Ann would like to understand that. And you mentioned asset. Okay, so her question about asset dissipation was answered, but she'd like you to talk a little more about credit rescoring.
Okay, credit rescoring is a very common practice that we use in lending, and it involves basically, I run a credit report. It is considered a hard pull. I then look at the scores. Depending upon what you are looking to do as the consumer, I then work with a special software program we have to determine what is it going to take for me to boost your scores 10 points, 30 points, whatever I need for a certain type of loan program. So it depends on the type of loan you're going for. Some programs allow for lower credit scores than others. For instance, if it's a jumbo loan, I really want to see 740 and above. Okay. So it's a free service we offer whereby I go back to you with recommendations, and then it works. As we discussed briefly last week, it's a try to prove and process, but you have to follow the process.
Thank you. Please chat in your questions. We've got about 5 more minutes left. Oh, we had so many questions last week. Maybe we've answered them all today.
If you'd like to, you can unmute yourself too and ask the question. Wow.
That was easy.
You ladies have answered everything. Oh, there's some questions.
We have one.
Oh, this is a good question.
Oh, there's a bunch coming in.
Okay, so Elizabeth is asking, are any rules different for condos or townhouses versus houses? Good question. I don't know. Debbie.
That's a great question. The main difference, one of the main things we have to look at with the condominium is whether or not the association is strong and the complex is not in litigation. As long as there's no litigation, typically we're okay. I do have to count the HOA fee as part of the qualifying payment. Another thing I'd like to mention is condos typically carry a higher risk to the lender and to Fannie Mae and Freddie Mac. And so the interest rate might be a tad higher than a single family home.
It looks like there was a follow-up question to the rescore. What are some of the common actions that are needed for the rescore process?
Okay, so what happens is, let's say you have a lot of revolving debt, and this program that I work with is going to tell me how much each account has to be paid down to get the balance to under, let's say, 50%. It's an algorithm that's utilized. And so I literally cut and paste the email, and I always call it credit recommendations. And the recommendations will tell you, okay, on my Chase card, I have to pay it down to $624. I mean, it's to the dollar. If those steps are taken, which I'm hoping, whether it takes you a couple of weeks or a couple of months, you'll pay down the account, you'll get an updated balance letter from the creditor, and then typically the client sends it to me. When I have all the letters I need with the updated balances, I then submit that back for rescoring, and it's a permanent fix. It works. It works. We pay for the service.
Got it. You know what? A little birdie just told me through Facebook, the Facebook birdie, that today is Debbie's birthday. Oh! Happy birthday.
Thank you, Lori. Thank you, everyone. Thank you. And I'm at a corporate event all day, which is why I'm doing this from my phone, but that's okay.
And you have a lovely dress on, a nice birthday dress.
Thank you. But it's been a pleasure talking to everyone about this. Oh, thank you, Jacqueline. It's a good day. Any other questions?
I think we covered, there's lots of happy birthdays coming in now.
Thank you.
It looks like, do you work with co-ops in New York City? So
I have colleagues all over the United States. So if you want to put me in touch with them, yeah, I can get them someone who does that. Okay. And I could still be involved in it. But because of licensing requirements, I'm not licensed in New York. It's altogether different. So, but we have caliber colleagues all over the United States.
All right. Looks like we got everything. Were there any other questions? If anybody wanted to unmute.
Doris is asking best way to reach out. Doris, send Tracy an email.
And there's our contact information.
Oh, there we go. There we go. And that's my cell phone number, website, and then Lori's as well. We are here to help.
Wonderful. Well, thank you so much, ladies. It has been a pleasure having you here. We're honored that you could do this for us. And everybody else, we have 2 more sessions in our mortgage savvy session to look forward to. We'll send the reminders. And again, this session has been recorded. So as soon as it's available, we'll be putting it out for you. And I think that takes care of it. So I have everyone have the lovely afternoon or morning, depending on where you are.
Thanks to Savvy Ladies for hosting, and thank you, Debbie, for taking time out of the your work meeting to join us.
Thank you, Lori, and thank you, Savvy Ladies. Love this organization.